Hey everybody, just a quick update in the world of investing. And the news came across, I get a news feed on everything in the investing world. And every once in a while I see things that are interesting. And boy, look, record annuity sales. I know the word annuity scares off a lot of people, but there's some legitimate reasons why. And so just wanted to hit some of the highlights of this news reel that came through. So total money invested was up nearly 50% in annuities. Every major fixed annuity product line experienced at least double-digit year-over-year growth. So that's tremendous considering 2022 was a record year as well. Annuity sales in 2023 are projected to exceed $300 billion for the second consecutive year. So to my point that I've made in several of my classes and videos is there's a huge migration going on from the bond fund world to the fixed and fixed indexed annuity world. People are finally starting to realize the value of these investments. And they're realizing the lack of value in the variable annuity world. If you're going to be in a variable annuity, you're either doing it for the benefits you're paying fees for, like an income rider or maybe a fancy death benefit or something like that. Otherwise, you can own the mutual funds without the extra layer of fees. So very limited reasons to utilize those variable annuities, because tax deferral is a double-edged sword. At some point, you have to pay taxes on that money, and it takes good taxes, long-term capital gains and qualified dividends, and turns them into interest. So people are starting to realize the lack of value on these variable annuities. So the biggest shining star is the fixed annuities. People have found them finally. Unfortunately, they don't pay a big enough commission, so it takes the consumer to force it on their advisor, right? These are CDs from insurance companies. You stack them up side by side to any corporate bond or CD, and this is going to be the choice you're going to walk away with. These are better than individual bonds and CDs. They always have been. They just don't pay enough commission to the advisor for them to want to give them to you. That's the terrible side of our business. So $40.9 billion in the first quarter this year moved to fixed annuities. Again, just CDs from insurance companies. You're looking at interest rates in the mid fives. These are like CDs. They change every day. So, just the other day, I got 5.65. Right at the turn of the year is the highest we saw. I saw 6.15 on a 5-year. So just bouncing around a little bit from carrier to carrier. We'll see a little differences, but the vast majority of all of these things, they are tax deferred compound interest. So difference than CDs. Most CDs pay simple interest. Some of them pay compound, whereas on fixed annuities, most fixed annuities are compound interest. Some of them will pay simple interest. And then 10% penalty-free access each year. So that gives us the ability to do a 5-year fixed interest rate like that. I wouldn't go too much further than that. You're losing really the value to do that. But first of all, getting access to this money and limiting it to 10%, let's be honest, you shouldn't be pulling more than 10% of your portfolio each year anyways. So especially for required minimum distributions, these are very IRA friendly. This is where you need that withdrawal from. This is where you want to utilize these types of things. And again, typically higher rates than CDs. Number 2 came in $23.1 billion in the first quarter into fixed indexed annuities. Okay, so these are just a version of fixed annuities, fixed interest rate, fixed period of time. The only difference is the fixed indexed annuity gives you an option to earn interest based on how the stock market did. Okay, so you look at the stock index performance in your contract. The insurance company will lay out a handful of stock indices. And then they will also lay out the math that they will have to utilize to pay you interest. So I'm using an example here because this is a generic stock index going up and down, up and down, up and down. Then they apply the math. In this case, it's called a participation rate, no cap. Don't usually like caps. In this case, they multiply this percentage by the performance of the stock index, anniversary to anniversary, point to point. Okay. In my example here, it's January 1st to January 1st. Okay. So if the stock market's down, they pay you nothing. If the stock market's up, they apply the math and pay you the interest they owe you. And they do this on every anniversary. Up, they pay you. Down, they don't. Up, they pay you. Down, they don't. Zero is your hero. When the market goes down, you're happy just not to lose anything. But the thing that makes these more, more better, superior, whatever we want to call them, better as a safe investment is that we have choices. Not only will they give us a handful of different types of stock indices and different math that allows us to earn interest, but they will also give us a fixed interest rate. So we can sit back and just earn a fixed interest rate. And what more could we want from a safe investment? We want to have the ability to earn more, and we want the ability to just sit back and earn a fixed interest rate. Well, we have all of this within one fixed indexed annuity. And so in this example, 3.5%, we can allocate anything that we want. So I have this allocated 60% to the stock indexing interest rates, which remember, our money is not invested in the stock market. The insurance company isn't keeping 5% of the profit for themselves. Remember, when the market goes down, you lose nothing. Your money is not invested in the stock market. When it goes up, the math is I'll pay you 95% of it. Some of these pay 170% of it. So it's just math. It's just them putting in the contract, here's how I'm going to pay you interest. Okay. So 60% of my money earns the indexed interest rate and 40% earns the fixed interest rate. And this is then what I would have earned because the stock market went down. 60% of my money earned nothing, but I still had 40% of my money earning 3.5%. And I earned 1.4% for the portfolio in a year where the world fell apart, right? That was 2008. And I still made money. And then I made 9, then I made 7, then 1, then 3, then 17. Woohoo! I win. Then 3, then 1, then 4, then 16, then 1, then 14. See, it's a bit of a roller coaster. And so some people need that stagnant return that they can live on that income that's coming in. But some people, this is just a safe place that we're going to withdraw from occasionally. This is a better, more ideal investment that comes with better returns. And we can change this allocation anytime we want. We could change it because we're going to use different stock indices. We could change it because they give us different math. It may be a 2-year strategy, maybe a cap, maybe a participation rate, maybe a margin. There's lots of different math out there, but there's also lots of different stock indices. And they give us the ability to change this every year, which gives us the flexibility that we need to handle this crazy investing environment. So this is really the safe investment of choice. This is where lots of that bond fund money is going. The fixed annuity is where a lot of the CD and individual bonds are moving to. So again, 10% access. Typically, you got 5 to 10 years on the guarantees on these things. After that, you get 100% access to your money. Long-term care, if you need it, 100% access. Death benefit, if you pass away, 100% goes to your heirs. No penalties on anything for long-term care or death benefits. No fees and no risk. That's the fixed indexed annuities. So big winners are the fixed and fixed indexed annuities. Lots of changes out there. This market is very interesting, and having stable, safe investments becomes very important to utilize properly in your portfolio. Hope that helps. If you need any help with any of these things, I've been screaming that these have been the safe investment of choice for a while. It looks like most of the world's figuring it out with the billions of dollars that are going into these things. Shoot us an email, give us a call if we can help out in any way. Always happy to help. I'm an advocate of using all investments without blinders. We can't just sit here and say all those are bad. You know, I had a friend that owned some Enron stock. That doesn't mean all stocks are bad. So be careful about the biases that we create out there. A good, well-balanced advisor understands all the tools available out there and utilizes them to the best of their ability for your advantage. So let us know if we can help out. Shoot us an email, give us a call. Check out the description area below. There may be some extra information or links in there for reports, things like that. Share the video with friends, subscribe to the channel. Always happy to help. See you next week.